We are beginning to see the unfolding of the result of the Federal Reserve raising interest rates for the first time in more than 3 years. A few of the clearest illustrations of this phenomenon is provided by the famous streaming services Netflix. Following the publication of two unsatisfactory earnings reports, the stock has declined by 64% since the beginning of 2022, resulting in the loss of greater than $100 billion worth of market capitalization. Bill Ackman, a billionaire hedge fund manager, is likely the person who has lost the most money due to Netflix. Following the publication of an unsatisfactory earnings report by Netflix in January, he made a purchase of shares in the company valued approximately $1.1 billion. This constituted roughly 10% of his total holdings in his portfolio. When asked about the company's prospects at the time, he stated that they had great growth potential, a management team that was the finest in their field, and that they were on the edge of attaining massive economies of scale. He claimed that short-term shareholders were unjustly driving down the price, which provided long-term investors such as himself with the opportunity to get in at an incredibly advantageous pricing. Shockingly, he changed his mind within a brief span of time. He sold out his whole stock, which resulted in a loss of $400 million for his investors. Netflix stated on the 20th of April that they had lost 200,000 subscriptions during the first quarter and they are on their way to losing 2 million users in the second quarter. This news came after Netflix reported that they had lost subscribers in the first quarter. This is the first quarter in which the company has experienced a decline in the number of subscribers in more than 10 years. Reed Hastings, the company's founder and CEO, blamed the terrible performance on users sharing their passwords and on the growing amount of competition. Welcome to Smart Stock Academy, where you'll discover videos about businesses and insights from your prominent CEOs. Thank you for joining us for today's video, and let's explore topics that will awaken your curiosity when it comes to stocks and investments. Make sure to like, share, subscribe, and click that notification bell to assure you that you'll be updated whenever we upload videos. Right now, we will investigate the reasons why Netflix is losing subscribers, while Bill Ackman made such a poor investment decision, and what the future holds for the firm. Netflix does not require an introduction because it is, by a significant margin, the most popular streaming service in the entire globe. They invest over $10 billion every year on amazing movies, which includes hits like Stranger Things and The Umbrella Academy that have received positive reviews from critics. With Netflix, it is possible to obtain thousands of movies and television series from all over the world for only $10 per month, which is cheaper than cable television plans. Netflix, which was the first company to enter this potentially destructive market, had meteoric growth, bringing the number of its subscribers from 40 million in 2014 to more than 200 million in 2021. It quickly rose to power as one of the most demanded stocks on Wall Street, eventually attaining a market capitalization of more than $300 billion. Netflix was a pioneer in the industry, earning Academy Awards and adding millions of new customers on the quarterly basis. So how did things turn out over the first quarter in Netflix? They announced a net loss of 200,000 subscriptions, which was the first quarterly loss in their company's history that spanned 10 years. In light of the invasion of Ukraine, this situation isn't quite as dire as it may first appear. When Netflix's service was discontinued in Russia, the company lost approximately 700,000 subscribers. If this hadn't happened, they would have possibly lost only 200,000 subscribers, which would have been manageable, but it appears that problems are just likely to get worse onwards. They have provided projections stating that they are currently on track to lose 2 million members in the second quarter, which would correspond to around 1% of their total number of subscribers. Given the quantity and quality of the contents that they produce, this might come off as surprising to all of us. It seems that they are only growing better with time. The quality work they produce was awarded 7 Oscars in 2021. Their show Squid Game debuted in 2021 and quickly became one of the most liked programs in the history of the platform, racking up 1.6 billion viewing hours. The question then is, why are they currently losing subscribers? Reed Hastings, who is the CEO of the company, cites 2 reasons for this: the act of sharing passwords and competition in the industry. We are all convinced that perhaps you and somebody you know logs in into Netflix using the account and password of another user. Netflix believes that their 100 million users used a shared account with someone who is not within those users' household in order to watch Netflix. This is almost half of the total number of paying subscribers that they have. Previously, they deliberately permitted users to share their passwords. They believe that if a person starts using Netflix through a shared account, the expectation is they will eventually decide that Netflix is worth the cost of a full membership and switch to using their own login credentials. Because Netflix was expanding at such a rapid rate around that period, the company didn't need to be very concerned about a few users exchanging their passwords. Their perspective has shifted right now as a result of the decline in the number of subscribers they have. If a subscriber of Netflix reveals their account with anyone who isn't a member of their immediate household, Netflix will begin charging that user a fee of between $2 and $3. They will check people's IP addresses against one another to see if they live in the same location. This stricter enforcement is presently being evaluated in 3 countries in Latin America, and it is anticipated that it will be implemented everywhere by the end of 2022. Even if they succeed in their crackdown on password sharing, this will just give them an additional $1 or $2 billion of revenue. That is a tiny change in comparison to the $200 billion that they have lost in market cap since they reached their all-time high in the past. It is abundantly clear that the sharing of passwords is not only the primary concern. There is another factor at play in this far more significant problem: the increase of new competitors that have recently entered the market. Earlier, Netflix had virtually no competition in the streaming market. The legacy media corporations were afraid that starting their new streaming services would hurt their cable television businesses. Therefore, they refrained from doing so. But during the course of the previous few years, there has been a significant shift in the situation. Today, streaming services such as Disney+, HBO Max, NBC Peacock, and Viacom's Paramount Plus are all investing billions of dollars annually in the creation of new content and the implementation of intensive strategies. The typical household in the United States utilizes 8.8 different streaming services, the vast majority of which are free and sponsored by advertisements such as Viacom's Pluto TV or NBC's Peacock. However, they also utilize paid services like Netflix and Disney+, which cost an average of $32 per month for a household, which is still a significantly lower cost than cable TV, which can cost as much as $70 per month. Nevertheless, it is getting more and more expensive for customers to use premium services. Consumers now have other options in contrast to the past when just Netflix was the only choice for them. Many people have come to the realization that their spending on video streaming is out of control, particularly in light of recent spikes in the cost of gasoline and other factors that contribute to inflationary pressures. Netflix production expenses are going through the roof at the same time that customers are cutting back on their spending. Netflix used to pay corporations like Disney, NBC, Warner Media, and others for the permission to broadcast their contents. However, these firms have their own competitive streaming services now, and as a result, they are gradually removing their content from Netflix. They have already been making up for this discrepancy by dramatically increasing the amount of original content that they produce for Netflix originals. But that is a costly process. Their expenditures on content have more than doubled in the past 5 years, going from $7 billion to $17 billion total. This wasn't a problem for them because they were growing their subscription base at a rate that was comparable, which allowed them to keep their profitability. The year-over-year gains in content investment that we've observed, despite the fact that their subscription numbers are currently declining, seem to be an increasingly unsustainable trend. In an effort to save money, Netflix dismissed the director of original animation, including the majority of his staff, and rejected other projects that were in the process of being developed. However, the lack of funding could further increase the deterioration of the number of their subscribers, which is made more difficult by the growing competition. In retrospect, the decline of Netflix seems to be an inevitability given the emergence of various competitions. Why on earth would anyone have anticipated anything different? However, the billionaire Bill Ackman went all out on the shares just 3 months before the company's subscriber growth started trending in the wrong direction. In January of 2021, Netflix disclosed earnings that were below expectations for the company's performance during the fourth quarter of 2021. They stated that they anticipated only 2.5 million net global subscriber additions in the first quarter of 2022. This would be the slowest growth rate they have experienced in a number of years. Because of this announcement, the value of the shares dropped by more than 25% in only one single day. Ackman had been paying close attention to the progress that Netflix made over the years. He has a strong conviction in the transition from traditional cable television to online streaming services, and he has been simply waiting for a better purchasing opportunity to develop a position in the stock. He acquired Netflix shares at a cost basis of approximately $360 each, spending a total of $1.1 billion on the company. Almost immediately, he communicated the decision in writing to the people who had invested in his hedge funds. He stated that Netflix still has huge growth potential, even though they had one bad season with subscriber growth that slightly missed expectations. The vast majority of analysts working on Wall Street anticipated that there would be 2.5 million additional customers per quarter moving ahead. Bill Ackman shared everyone else's astonishment and disbelief when Reed Hastings revealed that the company was on track to lose 2 million subscribers. In addition to its crackdown on the sharing of passwords, Netflix is going to offer a cheaper tier that will be sponsored by advertisements in an effort to win back customers who are into cheaper cost subscriptions. Ackman issued a second letter to the investors in his hedge fund almost immediately after the earnings reports were released. He claimed that given Netflix's difficulties in expanding its subscription base, the variety of possible potential results for the stock is too diverse for him to foresee, and as a result, he made the decision to sell the entire position for a loss of $400 million only 3 months after purchasing it. It is said that Ackman is a renowned investor. How is it possible that he made such a catastrophic mistake with this trade? There are several explanations for this. Ackman built his reputation as an activist investor throughout his career. One of his most noteworthy accomplishments was the purchase of a stake in Canadian Pacific Railways and the subsequent appointment of a new CEO who improved the organization's productivity. As a result, the value of each share increased to 3 times its previous level in just a few short years. In addition, he was able to make a lot of money trading around the time of the financial crisis in 2008 by taking a strategically placed short position on the banking business MBIA. In spite of his many achievements, he does not put his money into technological companies very often because he is not particularly knowledgeable in that industry. The letter that they provided, in which they explained his Netflix thesis, was incredibly brief and lasted on fewer than 2 pages. It would appear that he did not devote a significant amount of time or effort to collecting data on unit economics or the increasing levels of competition in the industry. Purchasing the shares so quickly following the announcement of the profit seems to be a rather rushed choice. Ackman claims that he is a dedicated user of Netflix and that his personal experience with the service may have influenced his choice of investment. How could you possibly believe that the stock was overpriced when you purchased it for $360 and then sell it for $220 just a few short months later? Ackman has stated that one of the most important things he has learned from his previous errors is to take immediate action whenever he uncovers fresh information that is in direct opposition to his initial investment thesis. When things aren't going as planned, it's generally best to cut your losses and hunt for other chances rather than hanging onto a position and hope things would be in a positive result. Numerous times, he has brought his hedge fund to the verge of collapse by doubling and tripling down on positions when it started moving against him. With JCPenney's long-term short-selling stake and the borderline fraudulent pharmaceutical business Valeant, as well as his multi-year short-selling war against Herbalife, which ended in over $1 billion of losses, he had a number of terrible holdings. With Netflix starting the decline in subscriber growth, Ackman recognized he is in over his head and has no idea what Netflix's future holds. Netflix, in contrast to a good number of other rapidly rising technology firms, generates a profit and is currently selling at a multiple of less than 20 times its latest profits per share. This represents a modest discount to the S&P 500. And despite the fact that they undoubtedly face challenges brought on by the expansion of the industry's competitive landscape, they remain the preeminent global streaming platform by a significant margin, with almost 40% of respondents to the survey indicating that they have the best selection of original content. Even if Netflix's early years of rapid expansion are now obviously in the past, it is indisputable that the company has created a world-class brand and will continue to exist for a foreseeable future. That's it for today's video. Let us know what you think and leave it in the comments section so we'll know what your insights are. Again, make sure to like, share, subscribe, and click the notification bell for more updated videos about the business world.